The first global corporation wasn't built on innovation, competition, or efficiency. It was built on monopoly, violence, and a government license to kill. Long before modern stock markets, long before corporate law, long before anyone talked about free trade, a single company figured out something far more powerful than supply and demand. It learned how to merge money and force into one machine and charge investors for the privilege of owning it. Most people believe capitalism emerged naturally. That markets grew at a voluntary exchange, gradually becoming more sophisticated as societies became more rational. But that story is comforting and incomplete, because the financial system we live inside today didn't start with freedom. It started with control. Welcome to the financial drive, where money, power, and history collide, and nothing is ever as simple as it looks. To understand how modern capitalism really works, you have to go back to something that now sits quietly on a kitchen shelf, something most people sprinkle without thinking. Spices. In the late 16th and early 17th centuries, spices weren't luxury flavorings. They were economic weapons. Nutmeg, cloves, mace, cinnamon. These were preservatives in a world without refrigeration, medicines in a world without antibiotics, and status symbols in a rigid social hierarchy. A small sack of nutmeg in Europe could be worth more than its weight in gold. Control the spice trade, and you didn't just make money, you reshaped entire economies. The problem was geography. Almost all of the world's valuable spices came from a tiny cluster of islands in Southeast Asia. Whoever controlled those islands controlled supply, and whoever controlled supply controlled price. At first, European powers competed. Portuguese ships raced Dutch ships. Merchants undercut one another. Profits fluctuated wildly. Some voyages returned fortunes. Others returned nothing but debt and bodies. Trade was risky, fragmented, and brutally inefficient. That volatility terrified investors, but it terrified merchants even more. Every time one trader flooded the market with spices, prices collapsed. Every time prices collapsed, profits evaporated. Competition, in theory, was good for consumers. In practice, it was disastrous for the people financing these voyages. So the Dutch did something radical, something that would permanently alter the relationship between money and power. Instead of competing, they consolidated. In 1602, the Dutch government merged several rival trading companies into one entity, the Dutch East India Company, the VOC. On paper, it looked like a financial innovation. It issued shares to the public. Investors could buy ownership, spread risk, and trade those shares without ever boarding a ship. For the first time, ordinary citizens could invest in overseas expansion. But that wasn't tea. The real innovation was what came next. The Dutch state granted the VOC a monopoly over all trade east of the Cape of Good Hope. No Dutch merchant could legally compete with it. No rival company could enter its territory. And unlike modern corporations, the VOC wasn't just allowed to trade. It was allowed to rule. It could wage war. It could build forts. It could sign treaties. It could imprison enemies. It could execute smugglers. This wasn't a company operating inside a state. It was a company acting as the state, with shareholders. Nothing says free market quite like banning everyone else. Once monopoly was secured, the mechanics of profit became brutally simple. Control supply, restrict output, keep prices. Anyone who threatened that balance wasn't a competitor, they were an obstacle. On islands like Banda, the world's only source of nutmeg at the time, the VOC enforced exclusivity with military precision. Local populations were ordered to sell only to the company, at prices set by the company. When they resisted, the response wasn't negotiation. It was annihilation. Villages were burned. Populations were massacred. Survivors were enslaved or displaced, replaced by forced labor imported to keep production running. Excess nutmeg trees were destroyed intentionally, not because they were useless, but because abundance was bad for business. Scarcity wasn't a failure of the system. It was the system. Back in Amsterdam, investors saw none of this. They didn't need to. Their experience of the VOC was clean, orderly, and financial. Regular dividends, rising share prices, ledgers regular dividends, balanced with exquisite care. The violence stayed overseas. The profits came home. And this separation between profit and consequence may have been the VOC's most enduring contribution to economic history. For the first time, thousands of people could benefit from imperial violence without participating in it, witnessing it, or even acknowledging it. Risk was abstracted. Responsibility was diluted. Ownership was reduced to paper. By the time the money arrived, the blood was already off the books. This was capitalism, learning how to scale. The VOC didn't just trade spices. It pioneered a system where brutality could be transformed into returns, where force could be converted into dividends, and where moral costs could be buried under layers of bureaucracy and distance. Investors didn't have to believe in conquest. They just had to believe in yield. And for a while, it worked spectacularly. The Dutch Republic grew rich. Amsterdam became a financial center. The VOC became the most powerful company on earth, with a market value that would dwarf many modern corporations. It paid dividends for decades. It endured wars, rebellions, and scandals. And it left behind a blueprint that others were eager to copy. Because once the world saw that monopoly, backed by the state, could generate reliable profit, the idea was impossible to unsee. And that's where the story gets uncomfortable. Because this wasn't Tian, Aberration. It was a beginning. What made the VOC truly revolutionary wasn't just that it made money. It was how it made money feel legitimate. For decades, the company delivered what investors cared about most: predictability, controlled supply, political backing. The méchance's of conquests was absorbed into the structure, processed by bureaucracy, and transformed into balance sheets. Violence became overhead. Exploitation became logistics. Empire became a line item, and this is where the VOC quietly rewired the logic of the financial system. Before the VOC, trade was personal. A merchant knew the risk because he sailed with it. Losses were direct. Gains were earned face-to-face with danger. But the VOC created distance, geographic, moral, and psychological. Shareholders didn't need to understand Southeast Asia. They didn't need to know the Banda Islands. They didn't even need to know what nutmeg looked like growing on a tree. They just needed to know the return. This separation changed everything. Profit no longer depended on personal accountability. It depended on structure, on rules written by those who benefited from them, on monopolies protected by law and enforced by force. Capital learned that it could scale faster when it no longer had to look directly at its own consequences. That lesson spread quickly. Other European powers copied the model. Chartered companies followed British, French, and beyond. Each granted monopolies. Each backed by the state. Each blurring the line between commerce and sovereignty. The idea that markets were neutral spaces of exchange gave way to something more realistic. Markets were tools, shaped by whoever had the power to design them. And yet, the story told to investors stayed remarkably consistent. These ventures were framed as progress, as trade, as civilization spreading outward. The language softened the reality. Numbers replaced names. Returns replaced lives. The VOC eventually declined, as all monopolies do. Corruption crept in. Administration bloated. Costs rose. Control slipped. By the late 18th century, the company collapsed under its own weight, nationalized by the Dutch state in 1799. On paper, it failed, but its logic didn't, because the real legacy of the VOC wasn't its lifespan. It was its structure. Modern financial systems still rely on the same core mechanics: distance between decision and consequence, abstraction of risk, concentration of power disguised as efficiency, profits privatized, costs distributed across workers, across regions, across time. The tools are different now. The language is cleaner. The violence is usually less visible. But the incentives are strikingly familiar. When corporations gain regulatory protection, when competition quietly disappears behind legal barriers, when complexity shields accountability, when profits depend more on access than innovation, you're seeing echoes of the VOC. not as history repeating, but as history evolving. This is why the idea of free markets is often more myth than reality. Markets don't emerge in a vacuum. They are built, designed, enforced, and the rules are rarely neutral. They reflect power, who has it, who keeps it, and who benefits when it's protected. Understanding this doesn't require sin. It requires clarity. The VOC wasn't evil because it was uniquely cruel for its time. It was brutal because brutality was profitable, and because the system rewarded it. That's the uncomfortable truth at the heart of economic history. Systems don't produce outcomes by accident. They produce outcomes by incentive, and incentives don't care about intentions. This is the part most people miss when they talk about capitalism as if it were a natural force, like gravity or weather. It isn't. It's a human construction, and like all human constructions, it reflects the values and power structures of the people who built it. The danger isn't that markets exist. The danger is forgetting how they were shaped, and why. Because when you forget the origins, you start believing the slogans. You begin to assume fairness where there is advantage, neutrality where there is design, freedom where there is constraint, and that belief makes you vulnerable. Financial education isn't about memorizing definitions or predicting the next crisis. It's about recognizing patterns of power, about seeing how profit and authority intertwine, about understanding that real wealth has always flowed toward those who control systems, not just those who participate in them. The VOC understood this 400 years ago. That's what made it so effective. And that's why its shadow still stretches across the modern financial world. As this story closes, the lesson isn't that capitalism is broken or that markets are evil. It's something more precise and more useful. Capitalism was never neutral. It was engineered, and once you see the engineering, you stop mistaking outcomes for accidents. History doesn't repeat because it has to. It repeats because the incentives remain familiar, and because each generation believes it's finally operating in a different system. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.